Hello, all, and welcome to today's session on Citytech CVC investing. I am very happy to have you all join us for Ventures Group's annual flagship event, the Smart Citytech Week. Ventures Group is a Citytech business builder and investor. I'm Richard Chu, an executive director here at Moelis & Company in Hong Kong, covering capital raising and M&A, and I'll be your moderator today. For this session, we brought together representatives from the corporate venture capital or CVC world of 4 companies across engineering, energy, telecommunications, technology sectors to have a discussion about the objectives of CVC and how it might differ versus typical venture capital fund investing and the role CVC has in advancing city tech. Now, without further ado, I will let our panelists introduce themselves, starting with Teng.
Hi, I'm Teng. I'm from ST Engineering, Singapore Technologies Ventures, headquartered out of Singapore, with global operations in 100 countries. Thank you.
Hi, I'm Brendon Joe from CLP Holdings. I'm head of Group Ventures and Research and based here in Hong Kong.
Hi, my name is Felix. I'm the Chief Strategy Officer for the Hong Kong Telecom Digital Venture.
Hi, I'm Paul Kingston. I'm an investment director with Honeywell International based in Hong Kong, where we invest in early stage technology and investments and funds.
Great, thank you all. And look, to kickstart the session, I will have Teng and Brendon give a short presentation on their company's CVC arms and their efforts. And then we'll follow that with a panel discussion joined by Felix and Paul. So Teng, maybe I'll hand it over to you to kick us off.
Thanks. I'm delighted to give you an overview of ST Engineering Group as well as our corporate venture capital program. ST Engineering, ST stands for Singapore Technologies. We are a global technology, defense, and engineering group. We were founded in 1967 and currently listed on the Singapore Stock Exchange since 1997. We employ about 25,000 people globally, of which 17,000 are engineers. Today, we have global operations in more than 100 local countries. So the corporate purpose for ST Engineering is to harness technology and innovation to enable a more secure and sustainable world. In terms of our business, we have many business divisions across commercial aerospace, smart city and digital solutions, and defense and public security segments. As you can see, we have 7 major divisions here. But for today, we'll talk about urban solutions, which is our smart city divisions. So in terms of our urban solution, what we look at, environment and smart security. And these 3 areas are actually underpinned by 3 horizontal capabilities, which are data analytics and AI, digital connectivity and cloud, followed by robotics. And for our smart cities division, we have done over 800 projects in more than 150 cities to date. And I'll go through each one very briefly. So this is a track record of our smart city divisions. It's actually more of a global business. Light blue will denote smart security, dark blue smart connectivity, and green will be smart mobility. Going to smart mobility first. These are some of the solutions and products that we have. We do a lot of smart mobility rail solutions, of which we have 7 key systems: mobility payment, passenger information systems, the integrated transport operations center, which includes cybersecurity for rail, smart metro control center, enterprise asset management system, and platform screen doors. These are capabilities and solutions that we have been developing since the 1980s, and to date, we are world leaders in a couple of these segments, top 5 in the world, for example, in the passenger information system, as well as in the platform screen door. Other than doing mobility rail, we are also into mobility road systems, where we've developed an AI-powered smart traffic management systems to improve commuter journeys. And this includes things like tolling and congestion pricing, fleet management system for buses, as well as for traffic, smart parking, EV charging systems, urban traffic management systems, and smart digital junctions. And these are some of the examples that we have, some of the recent track record. For example, in Dubai, our traffic management systems covers more than 500 kilometers of roads, which is more than 60% of the road networks in Dubai. And after implementing our systems, we have managed to improve the incident monitoring by over 60% and the response time by 30%. Another recent project we have was in Kunming, whereby we managed 26 highways and over 220 digital signages in Kunming. Again, data analytics and visualization were used to optimize management of traffic and road networks. The next segment we have is in smart environment. So smart environment, we have things like electrification, cooling, digital connectivity, lighting, and the water. What's interesting is that we have over time deployed more than 16 million wireless nodes and IoT solutions across cities worldwide, mainly in the smart street lighting space, as well as the water AMI space. So these are some of our smart lighting solutions. We do smart lighting at the estate level. We have light control systems, and as well as smart lamp posts, including some that will deploy in Kowloon, Hong Kong. And last part is on the smart digital connectivity. For smart digital connectivity, what we have developed is actually a smart city operating systems, where we drive integration and digitalization of services across different applications, as you can see on this slide. And of course, what is the outcome of this? We want to allow our clients to have more revenue opportunities, better user experience, and of course, cost savings. Smart security. Security is an important area that I look at. What is inherent in our smart security solutions is always analytics, AI, as well as facial recognition. So these are some of the solutions we have in terms of the security management platform, identity management platform, video analytics platform, as well as physical parameter and asset protection. And these are other solutions that we have developed. For example, the biometric access controlling that we have here in Singapore, as well as automatic in-car passenger clearance systems for the customs within Singapore and Malaysia. And surrounding Changi Airport, we also developed a parameter intrusion detection systems. And also in Thailand, we have a Thailand protection. So in a nutshell, that is what we have in terms of smart city solutions. In terms of the ventures team where I come from, we established in 2017, fund size of 150 million. We lead and syndicate deals depending on the situation, but of the 15 deals we have invested in so far, we led 70% of them. Invest anything up to 10 million per check per investment, but our first check sent between the 4 to 8 million range. Invest up to Series B. For us, we are strategic investors. So on the back of any investment agreement, we tend to have a very close collaboration agreement between the startups that invest in, as well as one of our business unit. So today, some of the areas we focus on will be robotics, autonomous technologies, cybersecurity, DA, AI, cloud, IoT communications, sustainability, and any other emerging tech. The main team sits out of Singapore, but we have two things like venture building as well as incubation for ST Engineering Ventures. Yeah. So in a nutshell, that's about ST Engineering and our corporate venture program. Thank you.
No, great. Thanks for that. And maybe just honing in a bit on the venture side of the business. When it comes to venture capital, it's a very competitive arena. I mean, you have other strategics in there as well, and more importantly, you have very aggressive, VC funds that are always looking for opportunities, willing to pay for unique propositions, let's say. And so, when it comes to that strategic angle, I suppose how do you position yourself specifically, let's say, and compete against other aggressive capital providers?
Thanks, Richard. I think that's a very good question. I think the value proposition that a CVC can bring to the table is actually quite different from a VC, and that's what we realized after being in this, having operated a corporate venturing program for 6 or 7 years now. So basically, for us, and I think the value that each corporate can bring to the table is actually different depending on the mothership or depending on the industry that the corporate is in. And the role they play in the industry. So specifically for ST Engineering, typically when we engage foreign startups, especially those from the US or from Israel, there are certain values that we can bring to the table that VC might not be able to bring. For example, in the areas that work, for the startups that I work with, they tend to be in the smart city space, they tend to be deep tech. So typically for a deep tech startup, it's a very niche technology. Whereas for us, ST Engineering, in many cases, when we engage our customers, we are going in as a prime contractor. So there's a value for us to actually help to integrate the solution that the deep tech startup has into our overall solution before we engage our end customer together. On top of that, for ST Engineering, we are actually very strong. We have very strong distribution networks in Southeast Asia as well as the Middle East, and these are additional value add that startups from, let's say, US or some other parts of the world could leverage on. Specifically for us, and on top of that, the last value add that we bring to the startup is that I mentioned earlier that we have 25,000 staff, of which 17,000 are engineers. So basically, when we work with startups, there's usually a very strong technical or engineering component to it. So because of our strong engineering base, we can work very close with the startup in terms of co-development of IP, and we will tend to lead the co-ownership of IP. And of course, when we work with a startup, we don't go for the core IP of the startup, which is actually the crown jewel of the startup. What we do is we work, usually with the peripherals, areas where the startup may not find it too intrusive. We work together on those areas, or areas that which they would develop, not now, but probably in the future, but we can bring forward, and we'll develop these solutions and go to market early with the startups. So these are the sort of value add that we can bring to the table when working with startups.
Yeah, no, that sounds about right. And you kind of touched on this already, but as an engineering firm, you have quite a unique perspective into, I guess, smart city development and the technical aspects that these startups are getting into. And so I wanted to ask, maybe from your perspective, what can big corporations do versus nimble startups? And it's more about, let's say, the technologies and infrastructure development, and how is that, which types of that is better addressed by, let's say, large corporates versus smaller, more nimble, flexible startups? From your perspective, presumably you've seen sort of the wide spectrum of what's being addressed today in the world.
Thanks, Richard. I think to have to develop a very good smart city solution, I think it's important that a large corporate is able to work very closely with and able to tap onto the specialty of the startup. For example, in certain areas, startups can run very quickly. When they develop certain sensors or certain communication channels or certain connectivity, but the value that a corporate brings is actually the ability to sort of see things at a more holistic systems approach level, able to string things together, able to string different solutions together and provide backup solutions to those front-end solutions, and also providing the interface to the end customers and giving them confidence that the solution will work. Because in many cases, startups tend to be relatively small, they run very fast, they may not have a track record, a very strong track record, or they have less experience dealing with more demanding customers. These are areas which big organizations or big MNCs, like people in this panel tend to have, and these are sort of I would say structures and processes which we can work, help work very closely with startups and allow the startups to leverage on our channels to the end customers. I think that's the different role. So actually, for corporates like us, it's important to know how to work with the startups, given that they are very nimble and they may be operating at a different speed or different pace from the corporate. Yeah, so it's the role of the CVC to do that moderation and bring the startups in, carefully, without disturbing the main flow of the large corporate.
Yeah, no, that makes perfect sense. And actually, this might be a good segue into Brendon. Speaking of large corporates, CLP. Maybe we can turn it over to you to maybe just introduce your firm and your perspectives on corporate venture capital as well.
So happy to do that. Thank you. Let me share the screen. Hi, everyone. So I'll start off with a quick introduction to CLP for those who may not be familiar with our business. CLP is a leading power utility in the APAC region. We're headquartered in Hong Kong, where we have 80% of customers. And we also have operations in mainland China, India, Australia, and Southeast Asia. We operate across the entire energy value chain, owning over 23 gigawatts of power generation capacity and close to 17,000 kilometers of high voltage lines, and servicing over 5 accounts. Our corporate venture activities sit in the team I head up that is called Group Ventures and Research, or GVR for short. Within GVR, there are 3 functions. We have research that helps to keep CLP on track, keep track of the emerging trends and technologies that are relevant to our sector. Ecosystems is our key open innovation platform where we connect with startups to help us relieve pain points, achieve operational excellence, and develop new capabilities. And then there's the venture capital investment arm, which I'll talk about in more detail. So each team within GVR has a distinct and complementary field of view of innovation activities, and they're all parts of the puzzle that together complete the picture. The strategic value venturing brings can be summed up in 3 categories, really. So enhancing what we do. The energy sector is transforming at a rapid pace from both a competitive market and operational perspective. So we need to ensure we're armed with the tools and capabilities to adapt and respond to threats in order to remain competitive. Extending what we do. The changes we're seeing also presents opportunities for us to grow by venturing into adjacent markets, new business models, and new geographies, and exploring where we could be. This entails not only looking at our core, where we are today, but identifying and monitoring future developments that could critically impact CLP in the long term. I like to think of our purpose for venturing, reasons why we invest in ventures as threefold. So financial value usually isn't the main focus for corporate venture capital, but it shouldn't be neglected. This is partly about realizing returns on the investment, but also about opportunity costs. Many corporates have relied on internal R&D activities, but venturing can be a faster, cheaper, and lower risk way to carry out innovation. We look at strategic value in our venture investments to find innovative ways to expand into adjacent markets, develop new lines of business, remain competitive, and achieve operational excellence. Lastly, there's a lot of value from just being in the arena. And this is in reference to the Theodore Roosevelt quote, urging us to embrace the challenge to do more rather than just sitting on the sidelines and watching. By being in the arena as an active investor, we keep sight of the companies that have the greatest ability to impact the business. And there's value in keeping up with developments and trying things out. In terms of what we focus on, it really starts with decarbonisation. Particularly here in Hong Kong, we have a big challenge to reach net zero by 2050. Renewables will play a role, however. As we know, Hong Kong has a small footprint that doesn't allow for many renewable resources. So we look to invest in innovative technologies to help us decarbonise both our energy supply as well as the activities of our customers. As we move forward on our decarbonisation journey, that energy infrastructure would evolve to look and operate very differently. So that means investing in smarter grids and energy storage. Mobility is another key focus area, as electrification of transport is a way to significantly reduce emissions. So we look at innovative ways to accelerate the adoption of EVs. And finally, we see that the energy sector is moving to become more customer-centric. So we're looking for ways to elevate the customer experience and offer solutions outside of the traditional energy supply model. And since we're talking about smart cities, where is Citytech in all of this? I think similar to how energy is becoming more customer-centric, the built environment is also becoming more human-centric. Greater orchestration and connectivity between customers, where we live, work, and play, and what powers us. So if you consider these focus areas as being more upstream on the top and downstream on the bottom, I think where Citytech was traditionally focused on the customer end, it's becoming more and more ubiquitous and shifting towards areas that were traditionally core to the power sector. So what do we look for in venture investments? Since we're a strategic investor, our investments need to have relevance to our business. It needs to be relevant to what our business is today, but more importantly, where we want our business to be tomorrow. And one of the determinants of whether an investment is relevant to us is whether we can add value to the company. Because if we can add value, it means we're operating within the same sphere. We're a growth investor, growth stage investor, targeting companies with a higher level of technology and commercial readiness. In doing so, it means that the startup solutions are readily deployable, and this means our sweet spot would be typically Series A, B. And thirdly, we look for investments that have the potential to deliver the strategic and financial value that I mentioned. So I work with CLP. If you're a startup who's working on disruptive solutions in the energy space, we'd like to hear from you. CLP is a leading utility in the APAC region with a presence in several high growth markets. We operate across the whole energy value chain from generation through to customer. We have deep technical expertise in the energy field. This means we've got a huge sandbox and multiple channels to help pilot, co-develop and scale your business. And likewise, if you're a VC fund, please reach out. If you have a startup in your portfolio, you're looking for co-investment partners who could add value to your investment. Would love to hear from you. Thank you, and look forward to the panel's discussion that will follow.
Perfect. No, thank you for that, actually. And look, I mean, obviously, CLP is one of Hong Kong's leading investors in early stage investments. And when people think about power generation and transmission grids, people tend to think of those as localized sort of markets, localized investments, let's say. But when you take a look at how your approach to startup investing in digital, it's very global, right? And so, can you maybe talk about how deliberate that was? And then, what's the mechanism to bring home those benefits from international investments?
Okay, thank you. Yes, we currently have investments in Hong Kong, mainland China, North America, and Israel. We don't constrain ourselves to looking for investments just in our backyard, because the challenges brought on by the energy transition are global and the solutions are global. We need to look for solutions from leading startup around the world. When we look for solutions further afield, we consider whether a solution can be transferred and deployed to the areas where we operate. And I think that's the trick. That's the value add. It's a challenge where we really need to work with the startups to be able to deploy those solutions to where we operate.
Okay. No, that makes sense. And is it more sort of an operational post investment operational aspect that you look to benefit from, or is there a degree of control that you look to influence decision making and maybe open up new markets, for example?
Yeah, I think it's definitely post investment control, and as my colleagues will talk about as well, it's about where we can unlock channels, add value. So if you think about in the key markets around APAC, we've got the ability to be able to help the startup expand into the other geographies where we operate. Sometimes the startups start with a solution that is specific to an industry, and then they may want to be pivoting towards the energy sector. So we could help them come across as well.
Yeah, no, that actually makes a lot of sense. And then, you touched on a bunch of criteria, I think, for how you approach investing. And then you also mentioned that, part of your framework, while, obviously CVC is maybe, let's say, more geared to strategic sometimes, financial is also an aspect. You highlighted a bunch of criteria in relation to going into an investment. And then you also mentioned that financial aspect is also one of the key considerations when you look at an investment as well, in addition to strategic benefits. And so when you think about exiting an investment, how do you approach that, right? Because obviously an exit would imply selling down or looking for an IPO or something like that. How do you relate that to continuing to have a strong strategic
I think there's no major difference between CVCs and financial VCs or VC funds when it comes to exiting. A couple of things on this. I think there's an additional way that CVCs can exit. I think a corporate running a CVC may see that the investment is something that's so strategic that they may wish to increase their stake or acquire the business outright. So that's another avenue for CVCs. I think the other thing is, even if you exit or when you make an investment in a startup, it's really the working with the business units help bring that solution into the business and generate, say, a new line of business or making it work, improve operations or something like that. So it's really, that's a different work stream in itself from the investment. And just because we may want to exit or stay invested or whatever the situation may be, that work stream can continue, and those benefits will continue to throughout the organization over time.
Okay, no, that makes perfect sense. And maybe opening this up to Felix, large corporate in Hong Kong. I mean, does that view on how CVC functions, strategic benefit versus financial, is that also a similar concept for you guys? And so maybe you can talk about, if you could talk about, how do you see the mission of CVC differing from that of more financial-minded investment firms such as, VC, PE funds? And ultimately, how do you think about whether or not to incubate a concept internally as opposed to making that external strategic investment?
Yeah, sure. I think for me, when I look at a CVC, it's still financial return driven. It's just that for CVC, the way you define financial returns could have more components to it, right? It may not purely be a valuation play. There could be a synergy play. There could be a play where it drives better retention, loyalty of the core business line. When I looked at most CVC, the return specifically on the investment generally are not a big bottom line contributor of the entire company. Generally, they're not, except maybe one or two very, very good picks. But for most years, it may not be. So when the corporate looks at this, it really, can't just be based on the valuation play, right? We really actually try to measure the synergies also. How much we can do to drive core business, again, qualitative and quantitative return, to get a full assessment whether this is successful investment or not. At HKT side, we also do a lot of internal incubation. And partly it really depends on whether businesses or the staff comes up with ideas that they want to sort of run in a sort of incubated or ring fence place, so they can sort of build it up. Leveraging, again, is very similar to an external company. They're really leveraging the parent company or the group company's resource. But I think one key difference is they tend to know the company really, really well already. And for a lot of the external investment, when we bring them in to try to work with our internal stakeholders, there are advantages because there's already a financial tie. But the difficulties of a startup working for a large company, it still exists, even if you have a stake in them, right? How they look at sales, how they look at compliance and all these stuff. So one thing we do find sometimes with internal incubation is they already know network. They already know how certain things need to get done in the organization. And if we could provide them with the resource and the room to build up something, right? Sometimes we do see that the synergy happens a lot quicker than with an external investment.
Okay. Does time frame become a consideration as well? For example, let's say you wanted to achieve an objective or a milestone within the next 5 to 10 years. How do you set those? And does that then ultimately impact your decision to try to incubate or, just try to go and get let's say, leapfrog that time frame a bit by going externally?
Um, it's definitely a consideration, but not so much on the 5-year timeline. Rather, I think it's on a 1 year to 2 year because
Oh, wow. Okay.
regardless, I always do feel that a startup will move faster than even in internal incubation. Because internal incubation, there's some advantage and synergies, but it's still in a corporate environment. Even if you try to ring fence incubate it, it's still a corporate environment. It's not as startup, as agile still, right? So for things to which we believe really you just gotta hit the market running where the time is the key essence. Definitely that would be a check mark for an external investment, I would say, over an internal incubation.
Okay, interesting. And then maybe just tying it back to CLP a little bit. So obviously, when it comes to Citytech, energy is a huge area of consideration here, and Honeywell does quite a bit in that area. And so, Paul, I mean, can you maybe give us an example of one of the investments you guys have made and how that maybe impacts Citytech or the advancement of Citytech? I think there was a US-based investment, Redaptive, which could be a good case study, let's say. And maybe could you just comment on synergy opportunities and potential partnerships that could come out of that that then sort of advances smart city and how people look at energy?
Thank you for the question, Richard. Yeah, the Redaptive investment, we were excited for that opportunity, and we're really excited about the possibility for that to expand the availability of energy saving technologies to more and more commercial buildings. That is really a remarkable opportunity out there in the market in terms of what is left to be done. If you factor in that about, roughly speaking, 30% of energy consumption is going to go into those buildings, and a lot of them are consuming energy and they don't know where it's going or being used even on the asset level, let alone the device level. And that's a value chain just like any other thing. We think there's a lot of opportunity to drive savings for those customers. And that partnership with Redaptive is, I would say, the potential there is illustrative of all of the investments we do and something we prioritize, which is that partnership value. What can both Honeywell and the startup provide to each other that's really going to increase the value of the other in a way? And we can take those startups that are prepared and mature and ready with their technical solutions to our customer base. And when we are in roughly 10 million commercial buildings around the world with our existing technologies, that is a really significant value add for a company like Redaptive to capitalize on in the short term. Meanwhile, their data technology and financial structures really open up and expand the aperture for what's possible for those companies. So we're very excited about that potential partnership, and that's an element that we prioritize in all of our investments, which is what is the partnership going to be, what's the vision for it, and what are the specific plans and milestones, and what governance process do we have in place to monitor and ensure execution against those over time, so that both elements of the partnership are seeing that value.
Yeah, and so it sounds like one of the biggest advantages of CVC investing, especially for a company the size of yours, is really that ability to open up new markets for those startups, right? And getting them in the door, let's say, to the different customer base, and other portfolio companies, let's say, under your belt as well. So similar to something that Brendon was mentioning as well. And Teng, maybe just on this, obviously ST Engineering, maybe more Singapore based. What role does Singapore play I suppose, in advancing smart city development across the region. Do you see from your engineering, perspective, smart city being more localized, or is there, strong potential to become more of a regional impact, let's say?
Yeah, thank you very much. I think that's a very good question. Generally, I think Singapore, as you know, is a very, very small market. We have like 5.4 million people in terms of population. In terms of size, we are just slightly under 800 square kilometers. So what we do have in Singapore is that we have always been into a lot of digitalization. And urbanization in Singapore is a foregone trend. We have urbanized since the 1980s, and there's hardly any rural areas left. But Singapore is a very good sandbox, and we do have a lot of technologies, especially digital technologies, that we can actually apply to this sandbox. And a lot of we also have a lot of government projects, HDB, of which 80% of all our residential housing tends to be government led. So in this area, the government is very willing to at times test out new technologies, not just at the building level, not at the district level, and more even at the district level. For example, some of the key initiatives we had in the past couple of years have been like a district level, new residential projects. For example, in Singapore, we have this thing called the Punggol. Punggol is the name of a place at the northeast part of Singapore, Punggol Digital District, whereby it's going to be the first fully integrated work, play, and stay kind of a community for Singaporeans, whereby we combine industries together with schools, together with Institute of Higher Learning and residential areas together. And in this area, and for this particular project, ST Engineering, we have taken, we are the sort of like the digital backbone. The piece that we have been given is actually to create a digital backbone of this district, then of which we work with other large local enterprises as well as MNCs in Singapore to integrate a lot of the solutions we have into this digital backbone. And I guess going forward, Singapore, there are opportunities. So again, the market is small, but it's a good proxy for, in many cases, Southeast Asia. As you know, Singapore is like Asia for dummies. But going forward, the trends of urbanization, digitization is going very strong for countries neighboring Singapore, for example, like Indonesia, Malaysia, Philippines, Thailand, and all that. And Singapore, being successful in Singapore can be a good proxy to, future sort of like more contract wins in these neighboring regions. Yeah.
Okay, cool. And from your perspective, you mentioned mobility, environment, connectivity, security as sort of four pillars, let's say, of smart cities going forward. I mean, and I'd love to hear everyone's perspective on this actually. But from your perspective, from an engineering background, let's say, what do you think right now is, let's say, the most critical piece to get right first, right? Or is there a piece that needs to get built up properly, right? To enable Citytech, let's say, because obviously there's quite a different. There's multiple pillars here, but is there one overarching theme, let's say, that needs to be resolved first before everything else can kind of come together?
My own sensing is actually in the area of so for us we have smart environment, smart security, and smart mobility. I think the overarching piece that is very important is actually the digitization piece or the data analytics piece that cut across all these verticals. So for example, in Singapore, we work very closely with the government of Singapore to sort of like deal with some of these smart cities emergent issues. So for the longest time, we have always what we have always been working with the Singapore government about is actually where do people stay, because that's actually very important. And if we can have the right solution to having people being where they are to work, to stay, to live, then we can actually minimize a lot of movement across different jurisdictions. So a lot of the problems downstream will actually solve itself out. But of course, that's not such a simple solution, right? To decide where people should stay, because if we think that where they stay should be where they work and where they live and where they play, then we need to organize a whole of society approach to creating infrastructure surrounding that, and that's not an easy piece, and that requires massive city planning, and multi-interagencies approach to this.
Okay.
Good planning will be able to circumvent many of the bad execution.
Okay. No, that makes sense. I mean, planning is paramount here, I suppose. And maybe Felix, from a communications angle, I mean, what do you feel is sort of the next big thing in connectivity going forward? Let's say taking a 5-10 year sort of time frame. What do you see emerging, and how important is that for creating interconnections between different aspects of, let's say, smart cities?
Yeah, I think the connectivity piece is a very critical element. And as an example, even before I had this job, I used to run a construction SaaS business, and a lot of the use case related to these BIM models, which is these 3D models that you try to help to digitize construction workplace. It was very difficult to use in the construction site because there was always really bad activity. The system weren't up to that capacity, right? So that connectivity piece really helps with a variety of, I would say, smart city techs that builds on it. And interestingly, I still remember a few years ago, people said 5G will be the one that really revolutionized a lot of these, because whether it's autonomous driving, all of these, which turns out, I think now we're a lot looking more towards 6G to finally provide that level of connectivity that can enable a lot of these smart city tech visions that a lot of these. I think a lot still needs to be done. I mean, Hong Kong is very fortunate. I mean, our coverage of connectivity is good. Our stability on connectivity is good. But I think there will still be some level of improvement. And again, another example is this whole Web3 that Hong Kong is pushing to be a hub. We spoke about just physical construction, but on a Web3 construction piece, all these sort of sandbox games really need even better connectivity for people to enable through their mobile phone, right? That's another aspects of these sort of digital natives who lives in both a physical city and a virtual city nowadays, right? So yeah, all in all, I think connectivity will play a big role on multi aspects of smart city.
Okay. Yeah, no, that makes sense. And obviously with everything becoming more digital and creating interconnections with everything, I mean, data is also sort of a huge part of this. What's your take on the data angle, and how do you ensure that there's enough capacity, let's say, to facilitate everything that's going on, and everything else that's required, especially when you start considering 6G, for example.
Yeah, so I think now, well, I guess this year has been a very hot topic, especially with Gen AI as well. A lot of company, actually small, medium, because while we do a lot of consumer facing, we actually have a very, very large commercial business. We don't invest a lot of B2B startup, but we do work with a lot of them as a strategic partner. And actually providing them with the capability of Gen AI is something we try to do. I guess more than just the data size of the data, a lot of them is do with security now, because there's a lot more requirement compared to a few years ago when AI was hot. Now there's a lot more about where your data resides, which sort of models you can use from different countries. One model may be available today, they might get cut off right tomorrow, and if your entire business model is built on that, it might have a very big impact, right? So honestly, less about size of data, but again, a lot more to do with data location, the models, how you're training the models with a combination of your own internal data in a secure manner, but while taking advantage of the external data. That actually been a bigger area which I've seen a lot of conversation.
Okay, no, thanks for that perspective. And for all of this, Brendon, any comment, let's say, on the energy side and what you think is the next, evolution, let's say, in terms of power gen or maybe grid with regards to distribution transmission as Citytech evolves and we move more.
I think you cut out a couple of times there again, but I'll just take the question as being, what's next for from the energy sector's perspective for
yes thank you.
Smart cities. So yeah, I think with the energy sector and smart cities, I think the point Felix made about the connectivity is a good one. I think with the power sector, we're seeing that, as I mentioned before, the industry is becoming more customer centric, and I think the next trend is really for having the customers control their energy a bit more. So it's not energy supply is not just in the responsibility of the power companies, right? I think more and more customers will be interested in controlling their power usage, when they want to use it, how much they want to use, through which devices they want to connect to the power system, a greater focus on energy efficiency, saving costs, etc. So I think that element of control we'll see more and more going forward for end customers.
And Paul, just staying on the energy topic for a bit, we just heard that, obviously things are going to evolve from an energy perspective, and being able to manage and control your energy is important. From Honeywell's perspective, do you share that view? And, how are you positioning yourself as, a CVC provider? Is that an area that you guys are focusing on, looking for new technologies to attack that energy savings angle? Is there more to go, or is there, sufficient know-how internally, plus, existing portfolio companies like Adaptive, for example, that can kind of get the job done, let's say?
Well, there's always more to be done, right? But I would agree with all the panelists, and I think Honeywell views it as there's a common thread running through them, from what Teng Lip said to digitization, and Felix about data rights and usage and security, to what Brendon said about that transition and providing more control. That control is only possible if you have those other two components, the data and the digitization, because you're providing a fundamental engineering technological capability to a customer, but in order for them to do it, they don't necessarily want to know the ins and outs of how the system works. They want to know that it works the way they need it to work, when they want it to do that. And that's the feeling of control, so that they can manage their business and their assets the way that they need to, in line with their own financial targets and their business objectives. But that all of those components, you need all three of them to get to that point. And for us, thematically, we view that as pushing the requirement of the user, that they sit at the edge of the network. So if you can push the functional capability to the edge of the network, all the better. But that also means you need to enhance their ability to make informed decisions at the edge of that network, which means you need more processing power there, higher data requirements at the very edge of the network. So what can you provide them that is going to be sitting there on the factory floor or at the facility manager's office, that provides that insight to them as they try to make an informed decision in line with their own business objectives? So I think all three of my fellow panelists have made great points here about this, and about the need, these fundamental technology needs that enhance and deliver those capabilities to the customer.
Sorry, just for a sec. No, but thanks, Paul, for that perspective. Yeah, you're absolutely right. When it comes to smart city, everything is but importantly, all of them have to work together. Say the most important sort of contribution here, right? Corporations that can provide not just financial capital, but also the capability and access, right, to make it all happen. That's quite important. Okay, so let me start with a question to Brendon. When it comes to evaluating investments and when it comes to these startups, especially in smart city, they can look quite small. And so for an organization as large as yours, how do you look at stakes, right? How big does the stake need to be? How important is the scale of the investment itself, right? And how do you look to size the stake that you go into, right? Both from a financial perspective, but also, let's say, from a control perspective as well, ensuring that you have sufficient rights as a shareholder. I'm asking this, I guess, more from the context of CLP being quite a large entity, right? And so, what is required to make it interesting, let's say, for you?
Yeah, when we consider the stake, sometimes it's not really up to us. Sometimes it's just up to how much is available, really. But I think when we look for venture investments, the stake is important in the sense that of governance. And I think it's important to realize that the startups are early stage companies, and it makes sense for startups to be nimble and to be able to shift their strategy and products to changing developments in the market. I think in terms of governance, governance has an important role to play in being able to shape the direction of the startups. And we need to ensure that the solutions of the startups remain applicable to us. So I think there's an element of being able to influence as well as help out with the co-development. I think if the stake is a bit too small, maybe won't be able to achieve that. In saying that, for the governments, we don't really plan to be so involved on the day-to-day level. We expect the startup to be able to be self-sufficient in a lot of areas.
Yeah, that makes sense. And Paul, Honeywell also is quite large. Do you have a different approach to assessing comes to investments that you guys make?
I think what we strive for is every company has a culture, right? And you want to, we're considered an industrial conglomerate. So we want to demonstrate to our investors and our shareholders that we're allocating capital efficiently and effectively. And so for our stakes on the venture side, they are less, they're significantly smaller than our operating businesses, but we want our businesses to exercise that feeling of ownership in terms of the partnership that they have with that startup. So it's not an ownership of the startup, it's an ownership of the partnership, and really feel compelled to drive results from that, because that's the whole point of doing these types of investments. It might be to introduce new innovations to your customers, new capabilities, and we want to make sure that we're demonstrating to our investors and our shareholders that we're doing that with intention and specific outcomes in mind. And so it is really, the interest should exceed, in a way, the check size, if you will, to put it in more base terms. It's not about that. Once we want that startup to feel that once Honeywell has committed to them, that Honeywell's behind them, and we're going to help them increase the value of their enterprise, just like they're adding to the value of ours, in terms of the offerings that we can take to our customers. So it's to solely look at the dollar size really isn't indicative of the significance that we put on these investments and their potential value to our customers, because our customers are something we really hold quite sacred. And if we're going to go out on a limb and introduce that startup, we want to make sure that we've exercised all the necessary diligence and can stand behind what they're putting out there as well. And I would agree with Brendon's point. it's not an issue of the startup's role is managing their business and operating their company every day, and that needs to be the case. But when it touches with Honeywell and when we go to customers together, that's really the ideal scenario for us. And when that part comes in, we want our project teams to be quite intimately involved. And that's not only to ensure that the startup is getting their value out of the partnership, but also that our team is onboarding learnings that this smaller, more nimbler, innovative company is really bringing to the industry. And then we're taking that not only to the customers there, but trying to use that to expand and accelerate our own innovation, product innovation cycles.
Okay, cool.
Actually,
And you know,
I wanted to echo Paul's point, because we spoke a lot about the upside, but actually there's I would say the downside protection, right? Which it's with a VC you can invest 10, and then if a few of them don't pan out, it's relatively more okay, because that's a model of VC. But for corporate, if we bring these startup to our business unit and thereby to our customer, a few failure could have a lot bigger downstream impact, right? On our company's reputation, on our core business. So that's actually one of the things, at least from my side, I don't know if everyone also agree, is that I also have to pay a lot of attention on what is the potential downside, or how comfortable we are with the company to start bringing them to our customers, both consumer or corporate customers.
yeah, it sounds like there's more qualitative assessment, beyond just the numbers that you have to consider when making these decisions, right? Okay.
Absolutely. To Felix's point, there are certain customers that, particularly if it's the first time you're doing something, right? You've got perhaps headline customers in a certain sector, let's say the energy sector, but there are other customers you may have that are smaller and perhaps lesser known, but might be a better fit when you're trying to introduce something that's really pushing the boundaries of what's been done before. It might be a better fit for that startup in terms of a customer, because maybe they can handle the demands of that customer better, and the risk tolerance on the customer side will be more readily calibrated to the risk that they're taking on by incorporating a new technology. So finding that balance, because everybody wants the headline customer, and that's great when you can deliver for them. Making sure you can deliver for those customers who are maybe further down the overall value chain, but really willing to push it on the innovation side, take that risk, might be a better fit.
Yeah, no, that makes a lot of sense, and quite important actually. And then maybe just on valuations. I mean, Paul, just in the context of the world today, I mean, high interest rates, the VC side, VC funds, they're not particularly doing that well these days. But environment, or the way you look at valuations for startups and these early stage sort of opportunities.
I think in this environment, there is an advantage to having that strategic focus, right? As you were very astutely asking those questions earlier about the balance between time and strategy versus financial return. And here's one where this is a moment where you have some additional flexibility, because if you know what your strategy is and this is where my intent lies for the future, venture investments, you should be thinking years down the road, not in the aggregate, right? You have an advantage in that, okay, I'm using balance sheet capital, so I can deploy when I find the right opportunity for the right business within our portfolio. And it's nice to be able to have the luxury of time on that side. Now, it hasn't gotten any easier to demonstrate the financial result, right? Because if you've got a higher interest rate, then presume you've got the higher cost of capital, and the onus on your efficiency of capital allocation hasn't gone anywhere. That's still there. It's still present. So your financial side has gotten just as equally difficult as anybody's, potentially. the luxury you have is, okay, well, I know what the strategy is, and these markets will continue to evolve regardless of what the interest rate may be and the current economic situation. It may impact the sense of urgency that people make decisions with, but it does allow you to take a step back and really delve in and say, what is the relevance of this business strategy at this moment? And is there another one that is perhaps more appropriate to focus on at this time? So you do have that flexibility and that security, but it's still striking the balance that you highlighted earlier on. And I suspect some of our panelists are dealing with the same dynamic as well. Got the same luxuries and the same challenges.
Yeah, does anyone else have any comment on this one? I mean, it'd be interesting to hear if there's maybe a divergent view on how valuations have changed, for startup investing from a corporate side. Felix, Brendon, something like that. Any thoughts?
Yeah, I'd echo Paul's view. I think having that strategic focus does give us that, I guess, luxury to be able to ignore short-term noise. Given that strategic focus, we can look at investments with a longer-term view, so we can look beyond cycles, for sure.
Yeah, and I think this is kind of where corporate venture capital really differs from venture capital funding or the financial side, right? You can sort of take into account the synergies that you're going to develop as opposed to the fund who's kind of just relying on, okay, what's the best allocation of my capital, especially when I have a 5-6% sort of risk-free rate that I have to consider. Right, you guys can afford to maybe think a little bit beyond that, right? And that's quite evident here. Okay.
Maybe let me jump in for a while. I think the current funding environment is actually quite. I agree with the rest of the panelists. It has allowed the CVCs like us to actually to be more focused and able to pick up the gems, because a lot of noise in the background has actually gone down. And on top of that, what has changed also is also that it's more difficult for startups to raise funds. And given the environment, people are no longer talking about 20 times revenues, 20 times EBITDA, but in fact they're asking their startups to start making, to reach cash flow positive earlier. And in this respect, I think as a corporate, we're able to, for good startups, we're able to give them those contracts or give them those recurring incomes that can help them to go cash flow positive earlier. And this is a strength which, as a financial VC, you won't be able to influence that. And in the past, this would matter less because they'll be continuously be funded by financial VCs. But given the lack of funding in general, this has actually accentuated the benefits of having a CVC on your cap table. Yeah.
So yeah, actually, that you bring up a really good point, right? You can directly impact the company's performance in a sense, right? Because you can help generate that much needed sort of initial cash flow, that initial contract that they require to really start lifting off, right? And so I don't know, maybe one way to think about this is actually in the current environment, this is where CVC investing actually has an advantage, right? Or maybe even preferential, right? To start gain from you vastly outweigh that extra capital, let's say, at the front. Yeah, that's a really interesting point. Great, and thank you. And here we are sharing insights into Citytech CVC investing. We hope you, the audience, have gained something valuable from our discussion today. Understanding the decision making behind CVC investments and what are some of their forward-looking thoughts is quite important, just given where we are today and the technology and how that's evolving. And so once again, you're watching Ventures Group's Smart City Tech Week, and we wish you a great day ahead.